Hello, welcome to Between the Margins. I'm Connor. Today I'm going to be starting a new series that I'm calling Foundations. The whole point of this series is to kind of get into the stock market from the ground up. This will not assume you have any pre-existing knowledge of markets or how they work. Pretty much every stock trading type content I've ever read myself has kind of assumed you have at least a baseline understanding of most things, and the baseline understanding bits are pretty hard to come across in a way that's easy to just understand from the jump. A lot of content I see kind of jumps straight into like portfolio strategies or like rules of thumb to trade on, but those aren't really useful if you don't have the core ideas behind it. So this series is an attempt to fix that. There's not going to be any shortcuts. There's not going to be stock picks. I'm not going to get into the weeds too much on any individual thing, but I will be kind of doing an entire encapsulation of what the stock market is, what stocks are, and how to get started with how all of this actually works. So this all starts with the most basic question you can possibly ask. What is a stock? Most people think they know what a stock is. You can buy it, you can sell it, you can watch the number go up and down, hopefully make some money. But if you ask most people what it actually is, the answers get pretty vague pretty fast. The vagueness does matter. A lot of bad investing decisions come down to pretty fuzzy idea of what you think you own versus what you actually own. A stock is not just a ticker or a line on a chart. It's a symbol that represents a company, and it doesn't move for no reason at all. When you buy a stock, you're buying a small ownership stake in an operating company. And this ownership comes with multiple different factors. You have a claim on all future cash flows of the company, residual claim on the company's assets if it ever were to get liquidated, and technically a very small say in how the company is governed. Although for most of us, that last one's pretty theoretical because it's such a small amount. None of these are guaranteed to be valuable, but they are the entire reason that stocks have value at all. If stocks were just pieces of paper people traded back and forth with no like claim on an actual business, they'd be completely worthless. It'd be entirely the greater fool theorem, and every single trade would be entirely based on what the next person's willing to pay rather than any underlying value. Now on to cash flows. So the first thing I was mentioning is cash flows as one of the stakes that you have ownership on. Most companies won't send you a dividend check every quarter, but a lot of people think that means that cash flows don't really matter for stocks that don't pay dividends. And that's not really true. They definitely do. They're just more indirect. Even if a company isn't paying dividends, we're led to believe that they're going to be doing something with that cash. They're going to be reinvesting it in the business, buying back shares, paying down debt, acquiring other companies. They're doing something with the cash that they're generating from the business. Over a long enough time horizon, stock returns are going to be driven almost entirely by how much economic surplus a business generates and what it does with that surplus. Prices can wander above or below this theoretical price for many months or many years at a time, but they can't escape it forever. So this is something we'll actually dig into more in a future post, going over how this value turns into an actual price. But here's the mental shift that kind of matters the most. The stock price is not actually the value of the company. Those are two completely different things. The price is essentially just where buyers and sellers currently agree on the price. That's it. It reflects expectations about cash flows, balance sheet strength, the economy, investor psychology, whatever narratives dominating the news cycle that week, but it's all baked into one number. Sometimes the price and the value are very, very close. Sometimes they're very, very far apart. And this is why, if you're paying attention, good companies can have terrible stocks and genuinely bad companies can go on incredible runs. Markets don't wait for the reality, they're constantly guessing at it, which means that if you can understand this difference between value and price, you can take advantage of low priced, high value stocks. Owning a stock doesn't mean you control anything. You can't force outcomes, you can't manage daily decisions, and you're fully exposed to the choices made by the people that you've never met that actually lead the companies. But that's actually a pretty good deal. The fragmentation of ownership is exactly what makes the public markets liquid and scalable. If every single shareholder was weighing in on every single decision the company made, nothing would ever get done. So you're giving up control in exchange for the ability to own a tiny piece of dozens or hundreds of businesses without having to do any of the work of actually running any of them. So once you make peace with that trade off, a lot of the emotional frustration around stocks and the price movements kind of dissolves. So that's mostly it for this episode 1 of the Foundation series about what a stock actually is. So just to recap, when you're buying a stock, you're not betting on a chart. You're essentially buying a probabilistic claim on a business whose future is genuinely uncertain. So, next time we're going to look at why these stock prices move even when nothing obvious happens to the company, and why most of the explanations people reach for regarding price moves are completely incomplete. Thanks for listening. I'm Connor. This is Between the Margins, and I'll see you in the next episode.